The gold to silver ratio just did something it hasn't done in years. And if you're not paying attention, you're about to miss one of the biggest wealth transfer opportunities of this decade. Right now, as I'm recording this, silver is absolutely exploding. We're talking about moves that typically take months happening in days, and the ratio between gold and silver prices has collapsed to levels we haven't seen since the last major precious metals bull run. But here's what nobody's talking about. This isn't just a technical chart pattern. This is the physical market screaming that something fundamental has broken. Let me show you exactly what's happening, because the mainstream financial media is completely missing the story. For those who don't follow precious metals closely, the gold to silver ratio is simple. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 1 over the past century. During normal market conditions, you might see it fluctuate between 50 and 70, but we've been living in anything but normal conditions. During the panic of early 2020, this ratio exploded to over 120 to 1. Think about that. It took 120 ounces of silver to buy a single ounce of gold. That was the most extreme dislocation in modern history, even worse than the 2008 financial crisis. Silver was being treated like an industrial metal in a collapsing economy, while gold was being hoarded as the ultimate safe haven. But here's where it gets interesting. That ratio has been steadily compressing ever since, and in recent weeks, it's accelerated dramatically. We've seen it drop from the high 80s down to the low 70s, and it's showing no signs of stopping. Some analysts are projecting we could see 60 to 1 within months, maybe even 50 to 1 if this momentum continues. Now, you might be thinking, okay, so a ratio changed. Why should I care? Because this ratio compression means silver is outperforming gold, and when silver outperforms gold, it doesn't just outperform by a little, it goes parabolic. Let me give you some historical context that'll make this crystal clear. In 1979 and 1980, during the last great precious metals bull market, silver went from around $5 an ounce to $50 an ounce in less than a year. That's a 900% gain. Gold went up too, tripling in price, but silver absolutely demolished it in percentage terms. The gold to silver ratio collapsed from 40 to 1 down to 17 to 1 at the peak. People who understood what was happening and positioned themselves in silver made generational wealth. Fast forward to 2011, the last significant precious metals rally. Silver went from around $15 to nearly $50 in just a few months. Again, gold went up, but silver was the rocket ship. The ratio compressed from 65 to 1 down to 32 to 1. Are you seeing the pattern? When the gold to silver ratio starts collapsing, silver doesn't just catch up to gold. It overshoots dramatically, and we're watching the early stages of that exact same setup right now. But let's dig into why this is happening, because understanding the mechanics will give you conviction when everyone else is panicking or doubting. First, there's the supply situation, and it's far more critical than most people realize. Silver is one of the only commodities on Earth where we're consuming more than we're producing. The Silver Institute's latest data shows we're running a structural deficit of over 200 million ounces annually. That's not a typo. We're consuming 200 million more ounces than the world's mines are producing every single year. Where's that silver coming from? Existing stockpiles, recycling, and above-ground inventories. But here's the problem. Those inventories are being depleted at an alarming rate. The COMEX, which is the major exchange where silver futures are traded and where physical delivery can occur, has seen its registered silver inventories drop by over 60% in the past few years. We're talking about going from over 400 million ounces down to around 150 million ounces. And it's not just the COMEX. The London Bullion Market Association, which handles the majority of global wholesale silver trading, has seen similar drawdowns. The physical metal is disappearing from the vaults, and it's not coming back. Why? Because silver isn't just a monetary metal anymore. It's absolutely critical to the modern economy in ways that gold simply isn't. Every solar panel requires silver. Every electric vehicle requires significantly more silver than a traditional car. 5G infrastructure, medical devices, water purification systems, electronics, batteries, the list goes on. Silver has over 10,000 industrial applications, and many of them have no viable substitute. The solar industry alone is projected to consume over 200 million ounces of silver annually within the next few years. That's almost the entire current deficit right there, just from one sector. And solar installations are accelerating globally as countries race to meet climate commitments and reduce dependence on fossil fuels. Electric vehicles are another massive driver. A traditional internal combustion engine car might use 15 to 30 grams of silver. An electric vehicle uses 25 to 50 grams, and some models use even more. As EV adoption accelerates, and every major automaker has committed to electrification, we're talking about hundreds of millions of additional ounces of annual demand that didn't exist a decade ago. Now, you might be thinking, if demand is so strong, why haven't prices already exploded? Great question, and the answer takes us into the murky world of paper silver markets and price suppression. The vast majority of silver trading doesn't involve physical metal at all. It's paper contracts, derivatives, and futures that are settled in cash rather than actual silver. On the COMEX, the ratio of paper silver claims to actual physical silver available for delivery has been estimated at anywhere from 100 to 1 up to 500 to 1, depending on how you calculate it. That means there are potentially 100 to 500 paper claims on every single ounce of physical silver in the registered vaults. This system works fine as long as everyone's playing the paper game and nobody's asking for physical delivery. But what happens when that changes? What happens when industrial users, investors, or even nation-states start demanding physical metal instead of accepting cash settlement? We're starting to see exactly that. Industrial users are securing long-term supply contracts directly with miners, bypassing the traditional market entirely because they can't risk supply disruptions. Retail investors globally have been buying physical silver coins and bars at record levels, draining dealer inventories. And perhaps most significantly, we're seeing signs that major institutional players are starting to position in physical silver rather than just paper exposure. There's a term in the precious metals world called a short squeeze, and silver is uniquely vulnerable to one. Here's how it works. Large banks and financial institutions have massive short positions in silver futures. They're essentially betting that silver prices will go down or stay flat. These short positions are used for various reasons, including hedging, market making, and yes, some would argue, price suppression. But when the price starts rising instead of falling, those short sellers face a problem. They either need to deliver physical silver they don't have, or they need to buy back their short positions at higher prices to close them out. And when they start buying to cover their shorts, it pushes prices even higher, which forces more short covering, which pushes prices higher still. It becomes a self-reinforcing cycle. We saw a preview of this a few years ago when retail investors coordinated on social media to buy physical silver and silver futures, attempting to force a short squeeze. The price spiked dramatically in a matter of days before the momentum faded, but that was a retail-driven event with limited capital. Imagine what happens when institutional money and industrial demand create the same dynamic, but with far more firepower and staying power. The setup today is even more explosive than it was then, because the physical shortage is real and worsening, not just a coordinated buying campaign. Now let's talk about the monetary aspect, because silver has been money for thousands of years, and that role is quietly coming back into focus. Central banks around the world have been buying gold at record levels. We're talking about over 1,000 tons of gold purchased by central banks annually for the past several years. That's unprecedented in modern history. Why? Because they're diversifying away from dollar-denominated assets and preparing for a potential restructuring of the global monetary system. But here's what's interesting. While central banks are buying gold, private investors and smaller nations are increasingly looking at silver as a more accessible monetary metal. You can't easily buy gold in small denominations for everyday transactions or as an entry point for wealth preservation. But silver? Silver is the people's money. It's affordable, divisible, and has the same monetary history as gold. We're seeing this play out in countries experiencing currency crises. When the local currency collapses, people don't just rush to gold, They rush to silver because they can actually afford it and use it. This happened in Argentina, Venezuela, Zimbabwe, and it's happening in various forms across emerging markets today. There's also a growing movement, particularly in certain U.S. states, to recognize gold and silver as legal tender again and to eliminate sales taxes on precious metals purchases. This isn't just symbolic. It's laying the groundwork for precious metals to function as parallel currencies if confidence in fiat money continues to erode. And let's be honest about where confidence in fiat currencies stands right now. We've seen the most aggressive monetary expansion in history over the past few years. Central banks printed trillions of dollars, euros, yen, and yuan out of thin air. That money didn't disappear. It's in the system, and it's eroding purchasing power. Real inflation, the kind you feel at the grocery store, at the gas pump, in your rent or mortgage, has been running far higher than official government statistics suggest. People are feeling poorer even as their nominal account balances might look okay, because their money buys less. This is the invisible tax of inflation, and it's driving more people toward hard assets like precious metals. Silver, in particular, is attractive because it's still relatively affordable compared to gold. You can buy a meaningful position in silver for a few $1,000s. Try doing that with gold at over $2,000 an ounce. For the average person looking to protect their purchasing power, silver is the accessible option. Now, I want to take a brief aside here because if you're sitting on a significant retirement account, this is relevant to your situation. If you have $100,000 or more in a traditional IRA or 401k, you might not realize you can actually hold physical precious metals in a specialized retirement account called a gold IRA. I put together a free guide that explains exactly how this works, how to do it without triggering taxes or penalties, and what to watch out for. It's in the description below. Worth checking out if you're thinking about diversifying your retirement savings into hard assets. All right, back to where silver prices are headed next. Let's talk about the technical picture because the charts are showing something remarkable. Silver has broken out of a multi-year consolidation pattern. For those who follow technical analysis, we're talking about a massive cup and handle formation, a bull flag, and a breakout above key resistance levels that had held for years. When you see these kinds of technical breakouts combined with the fundamental drivers we've discussed, the supply deficit, the industrial demand surge, the monetary debasement, the short squeeze potential, you get a setup that technical traders call confirmation. The fundamentals are telling you something big is happening, and the price action is confirming it. The next major resistance level for silver is around $35 an ounce. That's where the previous rally topped out over a decade ago. If silver breaks through that level with conviction, there's very little resistance until you get to the all-time high of $50 set back in 1980 and briefly touched again in 2011. But here's where it gets really interesting. Adjusted for real inflation, not the government's manipulated CPI numbers, but actual loss of purchasing power, silver's 1980 high of $50 would be well over $150 in today's money. Some analysts put it even higher, over $200 when you account for monetary expansion and the increased money supply. That means silver, even at $30 or $35, is still historically cheap. It hasn't kept pace with inflation, it hasn't kept pace with monetary expansion, and it certainly hasn't kept pace with the explosion in industrial demand that didn't exist in 1980. Think about what existed in 1980 versus today. No solar panels, no electric vehicles, no smartphones, no 5G networks, no modern medical devices that rely on silver's unique properties. The industrial demand case for silver is exponentially stronger today than it was at the last peak. Yet the price is a fraction of what it was in real terms. This is the opportunity. This is why the gold-to-silver ratio collapse matters. It's signaling that the market is finally waking up to this reality. Now let's address the elephant in the room: volatility. Silver is not for the faint of heart. It's going to be a wild ride. There will be days where silver drops 5% or more. There will be moments of panic, moments where you question whether you made the right decision. This is normal for silver. It's a smaller market than gold, which means it moves faster in both directions. But if you understand the fundamentals, if you understand that the supply deficit is real, that industrial demand is accelerating, that the monetary system is under stress, then you can weather that volatility. In fact, you can use it to your advantage, adding to positions on dips rather than panicking out of them. The key is to think in terms of ounces, not dollars. Your goal isn't to trade in and out trying to catch every move. Your goal is to accumulate physical ounces of silver while they're still available and affordable, and hold them as the structural shortage plays out over the coming years. Because here's what a lot of people miss. This isn't a trade. This is a multi-year trend that's just beginning. The supply deficit isn't going to resolve itself quickly. You can't just turn on new silver mines overnight. It takes years to bring new production online, and even then, most silver is produced as a byproduct of other mining operations, primarily copper, lead, and zinc. So silver supply is largely dependent on the economics of those other metals, not silver itself. Meanwhile, demand is accelerating. Every year, more solar panels are installed. Every year, more electric vehicles are sold. Every year, more electronics are manufactured. And every year, more investors wake up to the fact that their currency is being debased and look for alternatives. This is a supply-demand imbalance that's going to take years to resolve, if it resolves at all. And during that time, silver prices are going to have to rise to ration the available supply and incentivize new production. That's just basic economics. Let me give you another historical parallel that might help frame this. In the early 2000s, there was a similar setup in uranium. The world had underinvested in uranium production for decades, existing stockpiles were being depleted, and demand was starting to pick up as countries built new nuclear power plants. Uranium was trading around $7 per pound. Investors who understood the supply-demand dynamics started accumulating uranium stocks and physical uranium. Most people ignored it. It seemed boring, niche, not exciting. But over the next few years, uranium went from $7 to over $130 per pound. Companies involved in uranium mining saw their stock prices increase by 1,000% or more. It was one of the greatest commodity bull markets in modern history, and it happened because of a fundamental supply shortage meeting growing demand. Silver today has a similar setup, but with even more powerful drivers. The supply deficit is larger relative to the market size. The industrial demand growth is faster, and you have the added monetary component that uranium never had. Now, I want to address something important: how to actually position yourself for this. Because understanding the opportunity is one thing, but execution matters. Physical silver is the foundation: coins, bars, rounds, whatever form you prefer. This is your insurance policy, your monetary hedge, your stake in a tangible asset that can't be printed or debased. The downside of physical silver is storage, security, and liquidity. You need a safe place to keep it, and selling it quickly can sometimes involve premiums or discounts depending on the market. But the upside is that you own it outright. No counterparty risk. No bank or brokerage can freeze your account or prevent you from accessing it. In a real crisis scenario, physical metal is king. Beyond physical, there are silver mining stocks and ETFs. Mining stocks offer leverage to the silver price. When silver goes up 50%, a well-run silver miner stock might go up 150% or more because their profit margins expand dramatically. But mining stocks also come with company-specific risks: management quality, operational issues, political risk in the countries where they operate, and general stock market volatility. Silver ETFs offer exposure to silver prices without the hassle of physical storage, but you're trusting that the ETF actually holds the silver it claims to hold, and you're subject to management fees. Some ETFs hold physical silver, others hold futures contracts. Know what you're buying. There's no one-size-fits-all answer. The right approach depends on your situation, your risk tolerance, your time horizon, and your goals. But the key is to have exposure. Don't let analysis paralysis prevent you from taking action. Because here's the reality: opportunities like this don't come around often. We're talking about a structural shift in a critical commodity market that most people aren't paying attention to yet. By the time it's obvious, by the time silver is on the front page of every financial publication and your neighbor is talking about it, the easy gains will be gone. The best time to position yourself is when the fundamentals are screaming, but the crowd hasn't noticed yet. That's where we are right now with silver. The gold to silver ratio collapse is the market's way of telling you that something significant is happening. The question is whether you're going to listen. Let me paint you a picture of what the next few years could look like if this thesis plays out. Imagine silver at $50 an ounce, which would just match the previous all-time high from over 4 decades ago. At that price, if you bought silver today around $30, you're looking at a 65% gain. Not bad, but that's the conservative scenario. Now imagine silver at $75, which would still be below the inflation-adjusted 1980 high. That's a 150% gain from current levels. Your $10,000 position becomes $25,000. Now imagine silver at $100, which many analysts believe is entirely possible given the supply deficit and industrial demand trajectory. That's a 230% gain. Your $10,000 becomes $33,000. And if we see a true mania phase like we did in 1980 or 2011, where silver overshoots to the upside driven by momentum and fear of missing out, we could see prices that seem absurd today. Some analysts have targets of $150 or even $200 per ounce in a blow-off top scenario. I'm not saying that's guaranteed. I'm not saying you should bet your entire net worth on silver hitting $200. But I am saying the risk-reward is extraordinarily compelling. The downside from current levels is limited. Silver has industrial demand that provides a floor. The upside, given the structural shortage and monetary dynamics, is substantial. This is the kind of asymmetric opportunity that wealth is built on. Limited downside, significant upside, driven by fundamentals that are playing out in real time. And here's the thing, you don't need to be right about the exact top. You don't need to sell at the perfect moment. If silver goes to $75 and you sell at $60, you still did incredibly well. If it goes to $100 and you sell at $80, you still crushed it. The goal isn't perfection. The goal is to participate in a major move that the fundamentals suggest is coming. Let's also talk about the geopolitical dimension, because it's becoming increasingly relevant. We're watching a slow-motion restructuring of the global financial system. The dollar's role as the world's reserve currency is being challenged in ways it hasn't been since World War II. Countries are settling trade in their own currencies, bypassing the dollar. Central banks are diversifying reserves away from U.S. treasuries and into gold. The BRICS nations are discussing a commodity-backed currency. Whether that specific initiative succeeds or not is almost irrelevant. The point is that confidence in the current system is eroding and alternatives are being explored. In this environment, hard assets become more valuable. Gold and silver, which have been money for thousands of years across every civilization, become attractive again. They can't be printed. They can't be debased. They have no counterparty risk. They're the ultimate form of financial independence. Silver, being more affordable and accessible than gold, becomes the people's choice in this scenario. It's the metal that everyday individuals can accumulate to protect themselves from currency debasement and financial system instability. We're also seeing increasing tensions around supply chains and resource nationalism. Countries are realizing that control over critical materials, including silver, is a strategic advantage. We've seen export restrictions, tariffs, and stockpiling of strategic commodities. If this trend continues, it could further tighten the physical silver market and drive prices higher. Now, I want to be clear about something. I'm not a doom and gloom person. I'm not predicting the end of the world or the collapse of civilization. But I am observing trends that suggest significant changes are coming to the monetary and financial system, and those changes favor hard assets like precious metals. Even in a best-case scenario where everything muddles through and we avoid major crises, the supply-demand fundamentals for silver are strong enough to drive prices significantly higher. The industrial demand story alone is compelling. The monetary aspect is just additional upside. So what should you do with this information? First, educate yourself further. Don't just take my word for it. Look at the data. Read the Silver Institute's reports. Look at COMEX inventory levels. Study the industrial demand trends. Understand the mining supply situation. The more you know, the more conviction you'll have when volatility hits. Second, determine what makes sense for your situation. How much of your portfolio should be in precious metals? That depends on your age, your risk tolerance, your other investments, your financial goals. A common recommendation is 5 to 10% of your portfolio in precious metals as a hedge. Some people go higher, some go lower. There's no universal right answer. Third, take action. Don't let this be another thing you read about, found interesting, and then forgot about. If the thesis makes sense to you, if the fundamentals resonate, then do something about it. Start small if you need to. Buy a few ounces of physical silver. Open a position in a silver ETF. Research some mining stocks. But take that first step, because the opportunity is now. The gold-to-silver ratio is collapsing. The physical market is tightening. Industrial demand is accelerating. The monetary system is under stress. All the pieces are in place for a significant move higher in silver prices. The question isn't whether silver will rally. The question is whether you'll be positioned when it does. Will you be one of the people who saw it coming and took action? Or will you be one of the people who understood the opportunity but hesitated and then watched from the sidelines as prices ran away? History shows us that the biggest gains go to those who act when the fundamentals are clear, but the crowd hasn't caught on yet. That's where we are with silver right now. The smart money is accumulating. The industrial users are securing supply. The technical breakout is confirming the fundamental story. This is your moment. This is the opportunity that could define your financial outcome for the next several years. The gold-to-silver ratio collapse is the signal. The supply deficit is the fuel. The industrial demand is the accelerant. And the monetary debasement is the match. Silver is setting up for a rally that could rival or exceed the historic moves we saw in 1980 and 2011. The difference is that this time, the fundamental drivers are even stronger. The supply situation is tighter. The industrial demand is greater. And the monetary system is more fragile. Don't let this pass you by. Understand what's happening. Position yourself accordingly. And prepare for what could be one of the most significant wealth transfer opportunities of this decade. The silver rally is just beginning, and those who recognize it early will be the ones who benefit most. The gold-to-silver ratio has collapsed. The question is, what are you going to do about it?